All right, let's unpack this. In a world where interest rates are constantly shifting, how do you make smart investment choices? For both growth and safety. Specifically, when rates are low, where should you really be looking?
Today, we're taking a deep dive into two popular investment avenues: real estate investment trusts, or REITs, and corporate bonds. We'll explore how they behave in a low-interest rate environment, and critically, what hidden risks might be lurking, especially drawing lessons from some tough, real-world experiences right here in the Singapore market.
Yeah, exactly. So whether you're eyeing a higher yield for your savings or just want to understand the market better, we've got some crucial insights for you. You might think one of these is inherently safer, but, well, what we've uncovered reveals a fascinating and sometimes, frankly, alarming reality. Let's get into it. So let's start with the basics. When interest rates dip, what's the immediate effect on these two investment types? It's not quite as straightforward as good for one, bad for the other, and it.
That's spot on. Actually, when rates plummet, REITs don't just get a tailwind, they can almost hit the jackpot. What's interesting here is it's kind of a triple threat benefit for them. First, REITs rely heavily on debt to finance property purchases, right? So cheaper borrowing costs directly boost their margins. Simple as that.
Okay, lower cost. Makes sense.
Second, property prices themselves tend to rise. Why? Because their yields become more attractive compared to fixed income assets like bonds, which naturally lifts REIT valuations.
Ah, so the underlying assets become more valuable too.
Exactly. And finally, income-seeking investors often rotate into REITs. Their traditionally high dividends look even more appealing when bond yields are low. So you get stronger valuations, cheaper financing, and high investor demand, all contributing to REITs generally benefiting in a low-rate environment.
That sounds almost too good to be true for REITs in a low-rate world. Are there any immediate downsides or counter-arguments we should be aware of even then?
Well, yes. The main counter is that this assumes a stable economy overall. If low rates are actually a sign of a struggling economy, then property demand itself could drop, right? Which would impact rental income. But purely from a financing evaluation perspective, yeah, it's largely positive for REITs.
Okay, good caveat. Now let's switch gears. Corporate bonds. They're often seen as the stable workhorse of an investment portfolio, the predictable option. Do they get the same boost, or is it a different story altogether?
It's definitely a far more nuanced picture for corporate bonds. If new bonds are coming to market when rates are low, they will, of course, have lower coupon rates. That means less income for new buyers. Pretty straightforward.
Right, lower yield on new stuff.
However, if you already hold older bonds with higher coupons, their market price tends to go up. So that offers a potential capital gain if you choose to sell before maturity.
Ah, okay, so existing bonds get a price bump.
Yes, but bonds primarily provide predictable fixed coupon payments. That's their main draw. Once you've bought them, your potential return is largely capped unless you sell them early at that higher price. So while they offer stable income, corporate bonds generally don't benefit as much from low rates as REITs do beyond that initial price appreciation of existing higher coupon holdings.
Okay, so we've laid out the theory, the advantages, the nuances, corporate bonds, that stable workhorse we just discussed. They sound predictable, maybe even safer on paper. But our deep dive into the real world, particularly looking at Singapore, reveals a series of pretty devastating events that just shatter that perception for retail investors.
You hold on to that thought about corporate bonds being safer. What's really fascinating here is that the idea of corporate bonds as this universally safe bet needs a very critical lens, especially when we look at how badly investors were burned in cases like Hyflux, Swiber, and Ezra. It makes you ask.
Is safer for whom?
Exactly. Safer for whom and under what conditions? For many retail investors, that perceived safety was, well, it turned out to be something of an illusion. It often hid risks much more like volatile equities. And Singapore's market learned this the hard way.
Let's start with Hyflux then. It was a household name, right? A celebrated Singaporean utility company. What on earth went wrong there?
Hyflux. Yeah, there's a profound lesson for many people here. This company, once seen as a pillar of stability, defaulted on $900 million worth of perpetual bonds and preference shares back in 2018. So what went wrong? First, a massive misstep. Hyflux diversified heavily into volatile power generation with its two-spring plant. That became a huge financial black hole.
Okay, bad strategic move.
A very bad move. Second, the company was just drowning under an unsustainable debt load, just too much borrowing. And critically, there's a major corporate governance issue. Delayed disclosure, maybe even poor disclosure, of its growing financial troubles.
So not transparent enough.
Not nearly. And the impact was devastating. More than 34,000 retail investors, many of them retirees relying on that income, lost significant savings. Bondholders and, crucially, those perpetual securities investors were at the bottom of the repayment hierarchy. They recovered very, very little, often close to zero.
Wow. Zero. So essentially you're saying these perpetual bonds really mean perpetual risk for retail investors in a situation like that.
That's a good way to put it, yes. This case profoundly shook retail confidence. The lesson learned is that even a name you think is as solid as granite, like a utility company, can crumble, especially when it diversifies unwisely into volatile sectors. And perpetual bonds and preference shares, they are much, much riskier than plain vanilla corporate bonds. Why? Because of their subordinated status.
Meaning they're last in line if things go bad.
Precisely. In a bankruptcy, they're at the very back of the line for repayment, often recovering little to nothing after senior creditors get paid. So it's crucial to scrutinize leverage, sector risks, and really question if yields seem too good to be true, because they often are.
And Hyflux wasn't an isolated incident, unfortunately. Our research points to several other stark examples that underscore these very real risks.
Indeed. It wasn't just Hyflux. We saw Swiber Holdings, an oil and gas services company, collapse in 2016.
Yeah.
They had over $1.5 billion in debt, hit hard by the oil price crash, and again, over leverage. That led to defaults. That was a major shock default that actually prompted regulatory reforms here.
So that one really sent ripples.
It did. Similarly, Ezra Holdings, another oil and gas services firm, filed for bankruptcy in 2017. Over $1 billion in debt became unsustainable, also due to the oil price slump, another major blow to retail trust. Then there was Pacific Andes Resources Development Fishing and Seafood, defaulted in 2016. Over-leverage, weak cash flow. Even foreign issuers weren't immune. Trikomsel, a telecom company from Indonesia, defaulted on Singapore dollar bonds in 2015. Weak rupiah, poor financial management, highlighting currency mismatch risk.
Right, the currency risk adds another layer.
Absolutely. And finally, Perisai Petroleum Technology from Malaysia, also oil and gas, struggled repeatedly to repay bonds, constantly seeking extensions, just showcasing the inherent risk of these highly cyclical sectors.
Okay, after hearing about Hyflux, Swiber, Ezra, and the others, it's clear these weren't just one-offs. What's the bigger picture here? What are the overarching lessons these painful defaults teach us about the corporate bond market, especially for everyday investors?
These cases really drive home several crucial takeaways. First, sector risk matters a lot. Industries like real estate, oil and gas, power generation, commodities, they're highly exposed to macroeconomic shifts and price volatility. You have to understand the sector.
So don't just look at the company, look at the whole industry.
Exactly. Secondly, liquidity and debt servicing capability are absolutely crucial. Even profitable companies can fail if cash flow gets tight, if leverage is too high, or if they simply cannot refinance maturing debt when it comes due. We also saw how cross-default provisions can amplify risk.
What are those exactly?
Basically, if a company defaults on one bond, it can automatically trigger defaults on all its other debt. It creates a kind of cascading failure. Very dangerous. Fourth, SME or high-yield issuers tend to be more fragile. It's just a fact. Many of these defaults came from smaller companies or higher-yield, higher-risk issuers, not the big blue-chip firms. Those blue chips rarely issue bonds directly to retail investors anyway. And lastly, and this is key, investor due diligence is absolutely essential. You simply must scrutinize credit ratings, covenant terms, issuer transparency, track record, the whole 9 yards.
Okay, so given these painful lessons, what are the actual red flags, the specific warning signs you should be watching out for if you're considering a corporate bond? Because it sounds like just looking at the headline yield isn't nearly enough.
Absolutely not. Yield chasing is dangerous here. There are clear warning signs. Keep an eye out for missed or delayed interest payments. Or if the issuer frequently uses grace periods, that's often a sign of stress. Another big one, a rapidly increasing probability of default in credit models. If you see that jump, say from low single digits to double digits, that's a huge red flag.
Okay, watch the credit metrics closely.
Yes. Also, if liquidity dries up for a specific bond, making it difficult to trade, especially for lower rated or high yield names, that's a bad sign. And be particularly cautious if a company operates in a weak or distressed sector. Think shipping, oil and gas services, maybe some real estate developers, especially those with significant Chinese property exposure right now. And they have large debt maturities looming in the next 1 to 2 years, and their cash flow or refinancing options look shaky. That's a dangerous combination.
Right. Okay, so putting all these examples and warnings together, it's crystal clear that the old saying, corporate bonds are safer, needs a serious rethink. Our analysis really highlights a critical distinction in what we perceive as safe, doesn't it?
That's really the crux of it. Corporate bonds are considered safer for a few standard reasons. They offer fixed coupon payments, they have priority over equity holders in bankruptcy, and if you hold to maturity and the issuer survives, you expect to get your principal back. But the nuanced reality, as starkly shown by the Singapore cases, is that this lower risk label only truly applies to investment-grade debt from strong, stable, blue-chip companies.
Not the riskier stuff.
Exactly. Those high-yield corporate bonds, often tempting investors with attractive 6–8% coupons, frequently carry risk that's much more like equity risk. As those Singapore cases so painfully demonstrated to retail investors, you can lose almost everything.
So what about REITs then in the specific context? We talked about their risks earlier, but how do they stack up in terms of resilience when compared specifically against those high-yield bonds that carry equity-like risk? I mean, REITs are still property investments, right? Aren't property markets inherently cyclical and sensitive to economic downturns? How do they genuinely offer more resilience than a bond, even a high-yield one, that's supposed to pay out?
That's a great question. And it gets to the heart of the difference in risk structure. REITs absolutely have their own risks, no question. They're tied to property downturns, lower occupancy, lower rental income. That's real. They also carry leverage risk, as REITs are inherently debt-heavy by design. And yes, they are sensitive to interest rate hikes, which we discussed earlier. However, a key aspect of their resilience, especially compared to a high-yield bond default, is this. Unlike many high-yield corporate bonds that can literally go to zero almost overnight if the company defaults.
Like Hyflux perpetuals.
Precisely. REITs rarely, if ever, completely lose all their capital value. They might suffer from lower prices or reduced distributions, sure, but investors usually retain some capital and usually some income stream. Why? Because the underlying physical assets of the buildings, the land still exist and still have inherent value, even in a downturn. An investment-grade bond from a solid blue-chip company is indeed very safe, that's true. But that's a completely different beast from the high-yield bonds that tempted and burned many retail investors.
Okay, that distinction is crucial. So to make it really concrete for our listener, how would you put these two side-by-side high-yield corporate bonds versus REITs looking at income, capital risk, and liquidity, especially filtered through the lens of those tough lessons learned?
Let's break it down simply. For income, corporate bonds generally offer fixed coupons. REITs offer variable dividends linked to rental income and profitability. When it comes to capital risk, a high-yield corporate bond default can mean catastrophic losses, potentially a near-total wipeout. With REITs, you face property value fluctuations, market cycles, but a total wipeout is far less likely because those physical properties retain some value.
Okay, so the floor is potentially higher with REITs, even if they drop.
Generally, yes. Liquidity is also a major differentiator. Retail corporate bonds, especially high-yield or unrated ones, can often be very illiquid, hard to sell when you want or need to. REITs, on the other hand, are typically listed on a stock exchange, making them much easier to buy and sell on a daily basis.
Much easier access and exit.
Right. In terms of upside, corporate bonds are largely capped at their coupon rate, plus maybe getting par value back. REITs offer potential price appreciation of the units, in addition to the dividends. And for the downside, as we've said, for high-yield bonds, default can mean almost total loss. For REITs, you typically see declines tied to market and property cycles, rather than that complete wipeout scenario. So my concluding perspective, particularly after seeing these defaults, is this. If your absolute top priority is capital preservation, stick to government bonds or very highly rated corporate bonds like AAA or AA, no question. But if you're looking for yield, maybe with some potential upside, and you can tolerate market volatility, REITs may actually be a comparatively safer bet than chasing those too-good-to-be-true high-yield corporate bonds that have proven, time and again, to carry hidden equity-like risk.
That's a really important perspective shift. So bringing it to the present day with all these lessons in mind, what's the current word on the street for REITs, especially with the global economy showing signs of slowing and, crucially, a potential rate cut cycle on the horizon? Is it looking up for them now?
The current market environment is definitely shifting, and it's quite interesting for REITs right now. We saw the August U.S. CPI figures remain relatively stable, around 2.9% or 3.1% if you exclude food and energy. So inflation seems contained for now. However, there are signs U.S. companies are absorbing price hikes, which is squeezing their profitability and leading to some job losses. This could potentially push the U.S. towards a recession, maybe in 2026. Because of this, the Federal Reserve's priority seems to be shifting towards protecting businesses and preventing deeper job losses.
Which means rate cuts are likely.
Highly likely. The CME FedWatch tool, which tracks market expectations, is now indicating basically a 100% chance of rate cut at the Fed's September 17th meeting. The odds heavily favor a 25 basis point cut, around 92.5% probability, with a smaller chance, 7.5%, of a bigger 50 basis point cut. And beyond that, the market is currently expecting 25 basis point cuts in each of the following 3 meetings. So yeah, we're looking at a potential series of rate cuts.
And it's not just the U.S. influencing this, right? What's happening locally here in Singapore that feeds into this outlook for REITs?
Exactly. It's happening here too. The 3-month SORA, that's our key local benchmark for interbank lending, has seen a sharp decline. It was around 3% at the start of the year, but is down to about 1.563% in September, and projections suggest it could potentially hit 1.4% or even 1.2% by year-end.
Wow, that's a big drop.
It is. And this impending low interest rate environment, both globally and locally, significantly benefits REITs, particularly because a significant chunk, around 1/3, generally of their borrowings are typically at floating rates tied to benchmarks like SORA. So as these rates refresh lower, their interest expenses drop almost immediately, and that directly lifts their distribution per unit, or DPU, the payout to investors. As a result, most blue-chip REITs here are now expected to show positive DPU growth in the fourth quarter and heading into next year, primarily driven by these lower borrowing costs.
Okay, that sounds like genuinely positive news for REITs from a cost perspective. So what does that mean for their current valuation? Is it still a good time to buy? Is the boat still somewhat in the harbor, or has it pretty much sailed already?
Well, that's the key question now. A year ago, things looked very different. Many blue-chip REITs were trading at significant discounts, maybe 20–40% below their book value, and offered dividend yields over 6%. Back then, it was, frankly, almost a no-brainer buy for yield seekers. Now, the boat has largely left port, so to speak.
So the easy money's been made.
A lot of it, yes. Singapore blue-chip REITs are currently what I'd call fairly priced. The average price-to-book ratio is hovering near 1, specifically around 0.97x. And the average dividend yield is about 5.45%. So this isn't deeply undervalued territory anymore, but it's not necessarily overvalued either. Just fair. Now, looking at specific options. The CFA-WE ETF, which tracks Singapore REITs, offers a decent 5.4% dividend yield. That makes it a potentially good investment option for CPFOA funds, certainly better than the 2.5% risk-free rate you get there. But again, there isn't a huge margin of safety baked in at current prices.
Okay, fair value, decent yield. Any specific REITs standing out positively or negatively?
Well, Ling, which is a Hong Kong-focused REIT listed here, still looks interesting if you're comfortable with the Hong Kong market risk. It offers a higher 6.4% dividend yield and is still trading at roughly a 1/3 discount to its book value. It's seen as a bit of a lagging REIT because the Hong Kong market has been heavily focused on tech stocks lately. So that could be an opportunity.
A potential catch-up play there. Any thoughts on new offerings?
Well, there's a new IPO that just happened, Centurion Accommodation REIT. It's the second largest IPO here this year, priced at 88 cents. Focuses on worker and student accommodation. Now, I haven't done a full deep dive on it yet, but it's always a good reminder to be cautious with IPOs in general. We saw a previous data center REIT IPO, for example, that went underwater not long after listing, which wasn't great for early investors. So due diligence on new issues is key.
Absolutely. Okay, so let's try and wrap this up. What does this all mean for you, the listener? I think the most crucial lesson from today's deep dive is that not all corporate bonds are created equal. Far from it. And often, what seems like a safe, stable bet, especially in the high yield space, can hide significant, sometimes equity-like risks. We saw that clearly with the Singapore examples. Meanwhile, REITs, while definitely volatile and tied to property cycles, they offer a degree of transparency and maybe underlying asset resilience that can be more appealing in this kind of low-rate yield-seeking environment, especially now with the potential tailwind of falling interest rates helping their costs.
That sums it up well. Ultimately, the pursuit of yield nearly always comes with a commensurate increase in risk. That's just Finance 101. In a world of potentially falling rates, but also lingering economic uncertainty, really understanding the true nature of that risk. Is it the risk of a potential total loss from a bond default? Or is it the risk of fluctuation in property values and distributions? That understanding is far more valuable than simply chasing the highest coupon or dividend yield blindly. So maybe a final thought for you to ponder. What truly stands out to you now in differentiating between that perceived safety you might see on paper and the actual resilience an investment might offer when things get tough?